For a second straight time, the Bank of Canada has lowered the key interest rate, with it now sitting at 2.25%. 680 senior business analyst and editor Mike Eppel joins me now with lots of questions. First up, this was expected.
Yes.
Yes. So what are some of the factors behind this decision?
Slow economy. Central Bank Governor Tiff Macklem came right out and said it. This trade war has caused structural damage to our economy. He was not mincing words. They have given their forecast for 2026. They've cut the projection for GDP output by 1.5 percentage points from where they thought it would be when they made the previous projection earlier this year. That's how much things have changed over the past several months. And then you've got the U.S. president cutting off all trade negotiations. Macklem mentioned that too. It changes by the day. So under that circumstance, everybody's feeling it. The economy is slowed. You know, the structural damage, again, that he's talking about here has really diminished the growth prospects. They cut rates, and he says, and now we'll kind of wait and see.
Wait and see. So looking ahead, there is one more announcement December the 10th. I guess it's really hard to anticipate what can happen between now and then.
They're saying they're on pause, except or but.
Asterisk, yes.
Exactly. Because, you know, you could have some sort of a breakthrough on a deal, or maybe not.
Right.
There's just, they have to wait for the data. They always do that anyway. But I thought it was telling that they were even more cautious than normal on saying, we've got forecasts, but they're like this big. It could be one or the other, and they don't know.
Right.
And it was really a downbeat kind of a discussion by the central bank in this policy statement this morning. They were, again, not mincing words, that there's some work to do, and lowering interest rates are not the panacea. They're not going to, they can help in certain ways, but it's not going to necessarily help the auto sector or the steel or the aluminum and all these other things that are being hammered by trade.
There were a lot of people, of course, watching this announcement. Home buyers, perhaps. Like this will maybe make a little bit of a dent into this market.
It'll stabilize things. You know, rates are down a full, I think, 2% now from where they were at the peak to where they are now. So yeah, that's going to filter through if we can get out from under the clouds, I suppose, right? And eventually, you know, we've talked about this in the past. Next spring, I think that's when the real estate market's really going to turn. Again, it's location specific, type of market specific. Condos probably still slow. Detached homes, single, detached, all that, it's going to be moving. But right now, it's kind of okay. We're still kind of in a holding pattern, but maybe starting to improve on that front.
We are less than a week away from the Feds introducing their budget. So how do you see all of this playing into it?
That's going to be really interesting because on one hand, the Feds are also sending out mixed signals. It's going to be an austerity budget. They're going to be cutting jobs. They've already signaled that in the civil service. But they're going to be spending billions on big ticket items. So how long is that going to take to get into the system? And the central bank takes notice of that, saying, look, we'll wait and see what they're saying. If there are projects that could help, yeah, that's a good thing, obviously, for policy. And then they don't have to cut interest rates further. But yeah, the federal budget, that's going to be a big outlier.
It truly will. As always, we appreciate you stopping by. Mike Eppel, thank you.
Thank you.